Welcome to our beginner's guide on how to invest in stocks. If you've ever wondered how people grow their wealth through the stock market, you're in the right place. In this video, we'll break down the basics of stock investing, explain key concepts, and guide you step by step so you can start your investment journey with confidence. Whether you're looking to save for retirement, a big purchase, or simply want to make your money work for you, understanding stocks is a great first step. Let's get started by exploring what stocks actually are and why they matter. Stocks represent ownership in a company. When you buy a stock, you're purchasing a small piece of that company, known as a share. Companies issue stocks to raise money for growth, and investors buy them hoping the company will do well. If the company grows and becomes more valuable, your shares can increase in value too. Stocks are traded on exchanges, like the New York Stock Exchange or NASDAQ, where buyers and sellers meet. Understanding this basic concept is crucial before you start investing. You might wonder why so many people choose to invest in stocks. The main reason is growth potential. Historically, stocks have offered higher returns compared to other investments like savings accounts or bonds. By investing in stocks, you can potentially grow your wealth over time, outpacing inflation and reaching your financial goals faster. Of course, stocks come with risks, but with the right knowledge and strategy, you can manage these risks effectively. Not all stocks are the same. There are two main types: common stocks and preferred stocks. Common stocks give you voting rights in the company and the potential for dividends, while preferred stocks usually don't have voting rights but offer fixed dividends. Most beginners start with common stocks because they're more widely available and offer greater growth potential. Understanding the difference helps you make informed decisions as you build your portfolio. Stocks can make you money in two main ways: capital gains and dividends. Capital gains happen when you sell a stock for more than you paid for it. Dividends are payments some companies make to shareholders from their profits. Not all stocks pay dividends, but those that do can provide a steady stream of income. Both methods can help you grow your wealth, and understanding them is key to building a successful investment strategy. Investing in stocks isn't without risks. Stock prices can go up and down, sometimes sharply, due to market conditions, company performance, or global events. There's always a chance you could lose money, especially in the short term. However, by understanding these risks and learning how to manage them, you can invest more confidently. Diversifying your investments and having a long-term perspective are two effective ways to reduce risk. Before you start investing, it's important to set clear goals. Are you saving for retirement, a house, or your child's education? Your goals will influence your investment strategy, risk tolerance, and time horizon. Take some time to think about what you want to achieve and how much money you'll need. This will help you stay focused and make better investment decisions along the way. Risk tolerance is your ability and willingness to handle fluctuations in your investment's value. Some people are comfortable with big ups and downs, while others prefer stability. Knowing your risk tolerance helps you choose the right stocks and investment strategy. If you're unsure, start small and see how you feel as the market moves. Over time, you'll get a better sense of what works for you. One of the best ways to manage risk is to diversify your portfolio. This means spreading your investments across different companies, industries, and even countries. Diversification helps protect you if one stock or sector performs poorly. By not putting all your eggs in one basket, you can smooth out the ups and downs and increase your chances of long-term success. To buy and sell stocks, you'll need a brokerage account. Brokerages are companies that connect you to the stock market. There are many options, from traditional firms to online platforms. Compare fees, features, and ease of use before choosing one. Many beginners prefer online brokers for their low costs and user-friendly interfaces. Once you open an account, you'll be ready to start investing. After opening your brokerage account, you'll need to deposit money before you can buy stocks. Most brokers let you transfer funds from your bank account electronically. Some also accept checks or wire transfers. Make sure to start with an amount you're comfortable investing, and remember, you don't need a lot of money to begin. Even small amounts can grow over time with consistent investing. Before buying any stock, it's important to do your homework. Research the company's business model, financial health, and future prospects. Look at earnings reports, news, and analyst opinions. Understanding what you're investing in helps you make smarter decisions and avoid costly mistakes. Remember, investing is not about luck, it's about making informed choices. A stock quote shows you the current price of a stock, along with other important information like the day's high and low, trading volume, and price changes. Learning how to read stock quotes will help you track your investments and spot trends. Most brokerage platforms make this information easy to find, so take some time to get familiar with the layout and terms. Once you've chosen a stock and done your research, it's time to place your first trade. On your brokerage platform, search for the stock's ticker symbol, enter the number of shares you want to buy, and choose your order type. Review everything carefully before confirming. Congratulations, you're now a stock investor. Remember, it's okay to start small and learn as you go. There are different ways to buy and sell stocks, known as order types. The most common are market orders and limit orders. A market order buys or sells immediately at the current price, while a limit order lets you set the price you're willing to pay or receive. Understanding order types helps you control your trades and avoid surprises. After you've bought stocks, it's important to keep an eye on your investments. Check your portfolio regularly, but try not to stress over daily ups and downs. Focus on your long-term goals and review your holdings every few months. If your goals or risk tolerance change, adjust your investments accordingly. Staying informed helps you make better decisions over time. If you own dividend-paying stocks, consider reinvesting those dividends to buy more shares. Many brokers offer automatic dividend reinvestment plans, which can help your investments grow faster through compounding. Over time, reinvesting dividends can make a big difference in your portfolio's value, especially if you're investing for the long term. Compounding is when your investment earnings generate their own earnings. For example, if you reinvest dividends or your stocks grow in value, those gains can earn even more over time. The longer you stay invested, the more powerful compounding becomes. This is why starting early and being consistent are so important for building wealth. There are different approaches to investing in stocks. Long-term investors buy and hold stocks for years, aiming to benefit from growth and compounding. Short-term investors, or traders, try to profit from quick price changes. For beginners, long-term investing is usually safer and less stressful. It allows you to ride out market ups and downs and focus on your goals. Many beginners make mistakes like chasing hot stocks, panicking during downturns, or investing without research. To avoid these pitfalls, stick to your plan, do your homework, and don't let emotions drive your decisions. Remember, investing is a marathon, not a sprint. Patience and discipline are your best friends on this journey. Investing in stocks comes with costs, such as brokerage fees and taxes on your gains. Some brokers charge commissions for trades, while others are commission-free. You may also owe taxes on dividends and profits when you sell stocks. Understanding these costs helps you maximize your returns and avoid surprises at tax time. Dollar cost averaging is a strategy where you invest a fixed amount of money at regular intervals regardless of the stock's price. This approach helps reduce the impact of market volatility and takes the guesswork out of timing the market. Over time, you buy more shares when prices are low and fewer when prices are high, which can lower your average cost. If picking individual stocks feels overwhelming, consider index funds or exchange-traded funds, ETFs. These funds let you invest in a broad range of stocks with a single purchase, offering instant diversification. They're often low cost and easy to manage, making them a great choice for beginners who want to invest in the stock market without picking individual companies. The stock market is always changing, so it's important to stay informed. Follow financial news, read company updates, and keep learning about investing. The more you know, the better decisions you'll make. Don't be afraid to ask questions or seek advice from trusted sources as you build your knowledge. Emotions can have a big impact on investing decisions. Fear and greed often lead to poor choices, like selling during a market dip or buying into hype. Recognize your emotions and try to stick to your plan, even when the market gets turbulent. Staying disciplined is key to long-term success. It's a good idea to review your portfolio at least once or twice a year. Check if your investments are still aligned with your goals and risk tolerance. If not, make adjustments by buying or selling stocks as needed. Regular reviews help you stay on track and make the most of your investment strategy. Knowing when to sell is just as important as knowing when to buy. You might sell if a stock no longer fits your goals, if the company's outlook changes, or if you need the money for another purpose. Avoid selling just because of short-term market swings. Make decisions based on your plan and long-term objectives. A stop-loss order is a tool that helps you limit losses by automatically selling a stock if its price falls below a certain level. This can protect your portfolio from big drops, especially if you can't monitor the market closely. However, use stop-loss orders wisely, as they can also trigger sales during temporary dips. Market indices, like the S&P 500 or Dow Jones, track the performance of a group of stocks. They give you a snapshot of how the overall market or a specific sector is doing. Many investors use indices as benchmarks to measure their own portfolio's performance. Understanding indices helps you put your investments in context. Let's take a closer look at market and limit orders. A market order executes immediately at the best available price, which is great for speed but can result in unexpected prices during volatile markets. A limit order lets you set the maximum price you're willing to pay or the minimum you'll accept when selling. This gives you more control, but there's no guarantee your order will be filled. Dividends are a way for companies to share profits with shareholders. Not all stocks pay dividends, but those that do can provide a steady income stream. Reinvesting dividends can accelerate your portfolio's growth, especially over the long term. When choosing stocks, consider whether you want income, growth, or a mix of both. Sometimes companies split their stocks to make shares more affordable, or reverse split to increase the share price. A stock split gives you more shares at a lower price, while a reverse split gives you fewer shares at a higher price. These changes don't affect the total value of your investment, but it's good to understand how they work. Volatility refers to how much a stock's price moves up or down. High volatility means bigger swings, while low volatility means steadier prices. Some investors seek out volatile stocks for higher potential returns, but they also come with more risk. Knowing your comfort level with volatility helps you choose the right investments. Investing in stocks is a long-term game. Markets will have ups and downs, but staying patient and sticking to your plan is crucial. Avoid the temptation to make frequent trades or react to every headline. Over time, patience and consistency are often rewarded with better results. Everyone makes mistakes when learning to invest. The key is to learn from them and keep improving your strategy. Review your decisions, understand what went wrong, and adjust your approach. Over time, your experience will help you become a more confident and successful investor. Consistency is one of the most important habits for successful investing. Make regular contributions to your investment account, review your portfolio periodically, and stick to your plan. Even small, steady investments can add up over time, thanks to the power of compounding. If you're unsure about investing or want help creating a plan, consider working with a financial advisor. Advisors can help you set goals, choose investments, and manage risk. Make sure to choose someone trustworthy and qualified. Professional advice can give you peace of mind as you start your investment journey. Unfortunately, the world of investing has its share of scams and frauds. Be cautious of promises of guaranteed returns or pressure to invest quickly. Always use reputable brokers and do your own research before making decisions. Protecting yourself from scams is just as important as choosing the right stocks. Technology has made investing easier than ever. Many apps let you buy and sell stocks, track your portfolio, and learn about investing right from your phone. Look for apps with low fees, educational resources, and strong security features. Using the right tools can make your investment experience smoother and more enjoyable. News and trends can influence stock prices, sometimes dramatically. While it's important to stay informed, avoid making investment decisions based solely on headlines or hype. Focus on your long-term plan and use news as just one piece of your research process. The stock market moves in cycles, with periods of growth, bull markets, and decline, bear markets. Recognizing these cycles can help you manage your expectations and avoid panic during downturns. Remember, markets have always recovered over time, so staying invested through ups and downs is usually the best strategy. Investing is a lifelong learning process. Take advantage of books, courses, and online resources to expand your knowledge. The more you learn, the more confident and successful you'll become as an investor. Never stop seeking new information and improving your skills. Let's quickly review what we've covered. Investing in stocks is a powerful way to build wealth, but it requires knowledge, patience, and discipline. Set clear goals, understand your risk tolerance, diversify your portfolio, and keep learning. Avoid emotional decisions and stick to your plan for the best chance of success. Now that you know the basics, it's time to take action. Open a brokerage account, start small, and invest regularly. Keep learning, review your progress, and don't be afraid to seek help if you need it. Remember, every successful investor started as a beginner. Your journey starts today. Congratulations on taking the first step toward investing in stocks. Remember, investing is a journey that takes time and effort, but the rewards can be life-changing. Stay patient, keep learning, and trust in your plan. With dedication and smart choices, you can achieve your financial goals and build a brighter future.